Welcome to Surgeon Syndicate. If you're paying attention, you know that you only make money when you work. It might be great money, but it's dependent on you. The information on this podcast will help you solve that. We interview experts and provide analysis into financial freedom through commercial real estate. Why? To help physicians like you thrive. Let's dive in.
Welcome to Surgeon Syndicate. This is your host, Dr. Michael McManus, and here we are just before Halloween trying to take this scary out of real estate investing. Have you ever felt nervous about getting into a syndication deal, wondering if it's the right one? Today, we're going to break down the steps to spot a winner so you can invest with more confidence. Our goal here is to help listeners understand how evaluation of syndication deals with confidence can help them have more success investing, and how really focusing on sponsor credibility is probably the most important thing. But we're going to talk about some key financial metrics too. In the end, we want to help you at least be on the right start to asking the right questions to get the answers that you need. So why does sponsor due diligence matter? You know, the key here is that when you're investing passively, investing in a syndication, the key work is really the work you do before you invest. Because once you write the check, you're kind of handing it over to the sponsor to do their job. So sponsor due diligence is critical. What are the key things? I mean, the big things here is this is somebody that you feel like you know, like, and trust. And this is how do you get there? The more you can hear about them, the more you can see them interact, the more people you can talk to who they've dealt with before are key things. A lot of sponsors on that hand will have a presence on social media, or they'll do webinars. They'll do things like be on podcasts. Now, if they're not doing that, does that mean that they're not good sponsors? Actually, no, there's a lot of great sponsors who don't like doing this type of stuff because what are they good at? They're good at running deals. They're good at making you money. In some of those cases, they may just be really good and have their own investor base. And so they may not be reaching out a whole lot. So they might be hard to find. This is where talking to other investors can help you find some of these people. A lot of these people, though, will work with fund managers, and they'll let the fund managers go out and talk to the people and bring the money so they can focus on just doing the deal rather than the interacting with investors. So experience is key. What is their experience? This is not just experience in real estate, but experience doing the type of deal they're doing. And a key thing here is if they haven't done one of these deals before, are there people on their team? Is the whole team capable of pulling on this deal? I've got a deal right now I invested in passively a few years ago. It's a multifamily deal. It hasn't done well. When I invested on it, it was one of the first deals I invested in. And it sounded like they had a great plan. They'd been doing real estate stuff for a long time, but I missed some key factors that now I see and they totally stand out. These guys had just made a killing, had done a great job in the self-storage space. They pivoted into multifamily and they made some key mistakes. And that's why this deal's been in trouble. And it doesn't mean that somebody from another class can't enter a new asset class, but they need to have people on their team who aren't new. You know, we all know as doctors, you don't just one day wake up and you're a doctor. You go to school and you learn. Well, we can all go to school and learn, but then what residency is you work with more experienced partners who show you the ropes, and you work through a bunch of different experiences. And by the time you finish residency, you've got a much greater knowledge base. So that's kind of the key here, is that within the team, there's that knowledge base. Not everybody has to have it. And so with that comes the track record. Do they have a track record with investments in the past that shows that they know what they're doing? And it doesn't mean that somebody can't do a great job without a great track record, but the chances of success are much higher if they've done this over and over again. It's the same as, the chances of having a complication in surgery, if you've done this surgery once before, is very different than if you've done it 1,000 times before. It's just you're not going to get caught by surprise if you have that track record. So again, not everybody in the sponsor group needs to have the track record, but there should be people with key track record in each of the key points. Another key one is transparency. How well do they communicate with their investors? What's their communication plan? There's a lot out there that still just like to send emails, and that's fine. If deals are going well, I tell you, I would prefer just to have an email that I can take a quick gander at and go, yep, everything's on track, doing great, especially with people I've invested in it with before that I trust. But if things aren't going well, what do they do? And I think that's a question for them. So if things aren't going to plan, are going according to plan, how do you communicate with your investors? What are you going to do? To me, this is a spot where I want a phone call. If I've got money in your deal and your deal is not going off the way you want it to, I want to talk to you. I want you to take the time to talk to me, and I want to hear what's going on. The sponsors that I know and trust now all have always done this. And maybe that's the reason why, because this same deal I was talking about before, I've never gotten anything from more than an email from them. And they've done a couple webinars in the middle of all this distress. But even then, you get an email about a webinar. Nobody's ever called me. And I have a problem with that. I would just like, if you're dropping the ball, it's kind of the same. Like if you're a surgeon and you have a complication and you never go talk to the family, you send the nurse out to go, you know what? Patient's going to the ICU. They might not make it, but the doctor's filling out paperwork and doesn't have time to talk to you. That's how I feel about sponsors who communicate strictly by email. If things aren't going well, there need to be some phone calls. And so that's a part of a question of how have you had things go wrong before? And how do you deal with it? What do you do? And see if you like their story, if that fits with you. If you're fine with just getting an email asking for a capital call, that's great. I'm not. The other part, I think, especially in the beginning, is are they telling you up front what's risky about this deal? And this before we get into financial metrics, and we'll talk a little more about risk, but I think it's a key thing right off the bat that the two biggest things that I look for in sponsors is one, do they ask me what I'm trying to accomplish with this investment? Because if this is investment that churns off, 7% like clockwork and you get a check every 3 months, and there's no big upside, if that's what I'm looking for is just money to live on, that's a great match. But if I'm looking for money to live on, and this is a land entitlement deal that nothing's going to happen for like 14 months, and then you're going to get twice your money back. Well, I could live on that, but if I'm sponsoring a deal like that and somebody says, yeah, I'm looking for money to live on, my question is, do you have 2 years worth of money to live on? Because if you've got the cash in the bank or you've got other things and it's okay that if you want to double your money in 18 months and then live on it in 18 months, that works. But I need to know as a sponsor why that person's investing, what they're trying to accomplish. So if they don't ask you that question when you're talking to them, it's a red flag. And if they don't really come forth with, this is what I like about this deal, and this is what the biggest risks are, those are things that for me are tough. And we'll talk a little bit more about risk here in a minute. So key financial metrics. Now you're going to hear all these things. They're all very important. But before we go into them, a key thing to remember is most of these, especially if there's any projection in them, can be made to say whatever they want them to say. And again, good sponsors will underpromise and overdeliver. And if you talk to any previous investors, they're going to tell you, oh yeah, typically the IRR they quote you, they're going to blast past by quite a bit. But if you hear, well, it was a good deal, but it didn't quite live up to, I just find that a little concerning. I think it's okay to give a range. On the low side, I think it's going to be here. If it does great, it's going to be here. But there should be some honesty here and understand that a lot of these are just projections. So of these metrics, the big three, cash on cash return, internal rate of return or IRR, and equity multiple or EM. So the cash on cash return is basically the annual cash that's going to come back to investors based on the amount invested. So if you invest $100,000 and it pays you back $5,000 a quarter or $20,000 a year, that's a 20% cash on cash. It's a very simple metric, and it's one I like because it tells how is this deal going to cash flow. And right off the bat, I know how much money it's going to put in my pocket on a quarterly or monthly basis. So I know I have that money coming in. Now, internal rate of return measures overall profitability. And so there's more assumptions here. So back to cash on cash, when I look at cash on cash, step one is what is current cash on cash? So if I buy a building, again, going back, if I'm paying $100,000 for a building, after rent, or if it's a triple net lease, so none of that matters, and that I just get $20,000 a year back, that's a straight 20% cash on cash. So what is the current cash on cash? And then they'll have a projected cash on cash if there's anything they're looking to change, like if they're going to raise rents, if they're going to decrease expenses, if the building's partially leased and they're going to lease it out and have more people, then there's a projected cash on cash, which is how much it could make if everything goes as planned. So internal rate of return adds even more projections to that. That's saying we're looking at not just what the deal's doing today, but how this deal's going to produce a better cash on cash going forward, and what's it going to sell for at exit. And it takes all that money put together and then adds in the timeline. Did it do this whole thing in 1 year? Do this whole thing in 5 years? And then averages all that out to the internal rate of return will be your average yearly return over the course of the investment. And then equity multiple just tells the total cash return over the life of the investment, basically saying, if I invest $100,000 and when the whole thing's over, I have $200,000, that's an equity multiple of 2x. And it doesn't take into account how long it took to get there. So if I'm doing an equity multiple of 2x in 1 year, that's 100% return in 1 year. If it's a 2x in 5 years, that's only 20% per year. The IRR then adds back in, rent along the way and things like that. So key things though about IRR and equity multiple is they are projections, and they are saying this is the money you're going to make if our plan goes out the way it was supposed to. Now, in the years right after COVID, before interest rates went up, everybody was talking about IRRs of 20 to 25, 26%. And most any deal that started somewhere between 2020 and 2022 was promising 20% plus IRRs, and almost none of them produced that, because what happened? Interest rates went up, all their projections were off, and none of it mattered. So just understanding that a sponsor can make these numbers say anything they want to by changing what they put into their projection. An initial cash on cash can't be changed because that has to do with what you're buying the building for and how much money it makes right now. And to me, that's a key thing, because if you can start out with a cash on cash that's acceptable before you do anything else, that's a much safer deal. And there are fewer things that can go wrong. So that brings us to our next one, is risk mitigation. What are safe deals versus risky deals? And there's a lot of things that go into this. And here's a key example, because a lot of people, and I was one of them, I loved multifamily. I don't love multifamily so much anymore. Doesn't mean it's a bad asset class. It's actually right now one that there's a lot of pain going on. So it's a pretty good asset class in buying new projects right now. But why is it a safe deal? Well, part of the safety of multifamily is that if you buy if you invest in a syndication that's a 200 unit apartment building, Well, if any one tenant moves out, you just lost 1/200th of your income. So that adds a lot of safety. On the other side, it brings implementation risk, meaning as you go through the course of this investment, there's a lot of work that goes into keeping your tenants in the building. If a tenant leaves, there's re-renting, there's, keeping the pool clean. There's all these things that have to be done. So this is implementation risk, which is kind of the other side of that diversified or large number of tenants, making it a less risky deal. So the complete opposite of that would be investing with somebody in a Starbucks. So that Starbucks is a risky deal from the standpoint of it's one tenant. If that tenant leaves, you have an empty building. And when you sell an empty building, especially an empty commercial building, it's not worth a whole lot, because a lot of what you're buying when you buy a commercial building is you're buying the income. So a commercial building with a lease in place is worth a lot more. So that's the risk of a single tenant. What's the less risky thing? The good thing about that is you've got one tenant, it's Starbucks, you got a corporate guarantee. The chances of them not paying rent are very small. They're typically signing at least 10-year leases, if not longer. So once they have that lease, if you're investing in a Starbucks that has a corporate guaranteed lease, it's got 10 years left on that lease. The chances of and it's probably a triple net lease. So there's no implementation risk. I don't have to worry about anything. They're paying the insurance. If insurance goes up, it's their problem. They're paying the taxes. If taxes go up, it's their problem. If the parking lot needs redone, it's their problem. If the roof needs redone, it's their problem. They want to remodel, that's their problem. They just write me a check every month. So there's very little implementation risk in that. And there's very little risk in the money coming in changing over the next 10 years. And so it's very clear kind of where this product is going. Now, you also know that if you want to sell that in 5 years with 5 years left on the lease, it's not going to sell at the same cap rate or return, because now there's a little more risk because it needs to be released in 5 years versus 10 years. So, and there's the possibility if Starbucks wants out of a lease and you're a smaller time investor, they can lawyer you to death. The chances of you winning in a fight against them are low. It rarely happens. And that's part of why buildings Starbucks sell for so much, is because they've taken all that risk out. So it's just kind of a comparison of multi-tenant versus single tenant and what that means. And what are all the risks? So risks include, the number of tenants and how sticky are those tenants? How likely are they to leave? How likely are they to pay their rent? And if they're not paying their rent, who's guaranteeing the lease? Is it a bigger company who has billions of dollars, and so they're unlikely to default on a few $1,000s a month? Or is it a mom and pop and this is their whole thing? How big is the plan of what needs to be done to make this deal work? That's called implementation risk. I said, if you're buying an existing Starbucks with a lease in place, there's pretty much zero implementation risk. Once the deal's done, there's still some work to be done. If you're doing a heavy value add, so value add is when you're doing something actively to drive up the value of the property. There's a retail center down the street from where I live. They're doing a heavy value add. So they've redone the entire parking lot. It's probably 30 different units in there. They've probably got a third of them closed at any one time during this multi-year remodel, where they're gutting everything down to the studs and completely redoing it. So, and they're kind of moving through the building as they do this. So now the parts that have been redone look like a brand new building. They are absolutely beautiful, and they're drawing top dollar. The other half is still old tenants, probably paying a lot less rent and a lot junkier looking building. And in between is empty. So if you're investing in a deal like that, you're likely to get much higher returns, because the change from what that building was worth initially to what it's going to be worth on the back end is a lot bigger. So you may get great returns out of that. The risk is there's a lot of work to be done. And that entire remodel and releasing has to be carried out to perfection to get the perfect return. So that's the implementation risk again. And one other final risk is time risk. And this is one that a lot of people don't look at or don't think about. And it was kind of new to me the first time somebody brought it up. And we were looking at a land entitlement deal. And, the timeline to get the whole deal done was going to be 6 to 18 months. And that's what it comes when you're looking at, getting stuff done with cities and counties and governments and getting new licensing and such. And people are like, well, if it takes 9 months, should we just hold it for 3 months more so we can get capital gains taxes instead of regular income taxes? You owned it for less than a year. And the point that was brought up is, if you have a seller right now and you can do this deal and know what it is, versus I'm going to wait 3 to 6 months because I think it will be better. There's time risk in there. Time that right now you have something you can do right now. You can put money in your pocket and know what it is. And waiting, your things can change in that timeline. And that time risk is what killed everybody when interest rates jumped up and people had variable rate debt. So that's another form of risk. And there's one when you talk to sponsors is ask them, what are they concerned about? What's the riskiest thing in this deal? Now we got a deal right now that looks like it's probably dead. It was a great office building that was going to have great returns. Maybe another time when this is all passed, we can go into a lot more detail on it. But the risk on it was that there was just about 4 years left on the lease, meaning that in 3 years it had to be completely released. And if the tenant, which was a single tenant building, left, we'd now have an empty building. So that was really a huge risk, but it had great returns. And so the balance was, are these great returns worth the risk that possibly this building has to be released? In the wrong person's hands, that's huge risk because releasing can be a horrible thing. We're good with the deal because one of the partners in this deal is an ace at leasing office space. And so to me, it took a lot of risk out of the deal. Other things going on that probably this one's not going to happen, but that's okay. Better to let a not perfect deal go than to buy a bad deal. So, say, here's a question for you. When you start talking to a syndicator or a sponsor, what's the most important thing? Their track record, their market expertise, or their exit strategy? I'll give you a moment to answer the question in your head. We won't have a phone in on this, but to me there, it's market expertise. The exit strategy doesn't matter because if you can't carry out the deal to get to the exit strategy doesn't matter. Track record is important, but if that track record is in a different market, that kind of outweighs market expertise. Now, we could also make an argument that track record, because it shows you've done this deal before and you've done it multiple times and you know how to do it, is important. And if within that track record is it's in the same category, the same asset class, that would give you track record and market expertise. So, so there was your little quiz for today. So I hope this has been helpful for you. Really, the key to this was kind of really diving into what is it that keeps people from getting into syndication deals, and what are the key things you could be asking. This is one of my favorite things to talk about is if you're looking at investing passively, start calling sponsors. Every time you hear about a sponsor, you hear a sponsor's name on a podcast or even if it's a capital raiser, you get a flyer in the mail about somebody's doing a dinner to talk about a deal. Go to the dinner, have a nice steak, ask them questions, get a feel for what's going on. A buddy wants to introduce you to somebody, take the introduction, talk to them, go to the conference and talk to people. The more people you talk to, the more questions you ask, you'll look back and be like, man, that was a stupid question I asked before when I was just starting. I do the same thing now, but the more you do it, the more expertise you're going to gain and the better you're going to get at interviewing sponsors. And that's really what this is. It's an interview. You're trying to find out if there's somebody you want to hire to help your money grow. So again, I hope this has been of value to you. If anybody has any questions, you'd like to talk more, reach out. You can go to surgeonsyndicate.com, book a call. I love to talk to our listeners and find out what you like about the show and what you don't, and ask questions. I had a great call today with somebody who might be starting their own podcast, another doctor who's looking to reach out and help some people. And I just love that. So join us next time on Surgeon Syndicate. And until then, happy investing.
Do you care about paying too much in taxes? And would you like to save more of your hard-earned dollars? Here's what we found. We found that most financial professionals have a one-size-fits-all solution. So the question is, would it make it easier for you to have someone tailor your tax solutions to your individual needs so you can keep more of your money and do what you want with it? That is exactly what we do at 𝐥𝐸𝐲.
As surgeons, we know the difference between routine surgery versus life-threatening interventions. And I want you to know that I've used 𝐲𝐸𝐬 and her team for my personal financial intervention, and I love the results. I would do you a disservice if I didn't recommend them to you.
We'd love to help you, so let's jump on a call and see how we can collaborate. Simply go to www.𝐥𝐸𝐲.com/McManus and book your free call today.
This has been an episode of Surgeon Syndicate. If you got value from this episode, you know other surgeons are hungry to become job optional, and you can help them by sharing this content today. Schedule a call and we can make a plan. Looking forward to having you with me on the next episode.